Hi guys, welcome back to the YouTube channel. In this video we're talking all about how to build wealth in property in 2025 and beyond. As we know, the UK at the minute, we're in completely uncertain times with Labour's first budget coming up very soon and loads of changes potentially coming our way. We've seen in previous videos potential changes to capital gains tax, though now they've kind of watered those down. What we know at the minute is basic rate bands are being, like all the tax bands, including the basic rate and personal allowance, are likely to be frozen. Potential scrapping of entrepreneurs relief and a few others as well. But what we're going to do in this video is talk about how you can build wealth in property based on what we know now, and even take into account some of the potential changes coming our way on the 30th of October. So the first thing you want to do is make sure that you've got the right structure. Since 2016, buying property in your own name usually isn't the best idea, simply because the mortgage interest isn't tax deductible anymore. It used to be fully tax deductible. Now you only get a 20% basic rate tax credit, which for a lot of people is no good. And as we've seen, if the basic rate, the personal allowance, all the higher rate tax bands are frozen again, at the minute they're frozen until 2028, likely to be frozen further, this is going to push more and more people into the higher rate tax band, who will end up paying more tax on their rental profits and being worse off. So for this reason, unless you really do want a modest property portfolio, and this means kind of way under £50,000 worth of rental profits plus total income, any other income you've got, you need to be comfortably under the basic rate threshold. So about £50,000 worth of total income, you are probably better off investing through a limited company. So if you're a higher rate taxpayer at the minute, absolutely makes sense to go straight into a limited company, set up an SPV. We can help you do that if you can't do that yourself. Set up an SPV to buy property through. If you buy property in your own name, you'll be paying tax at 40 or 45% on those rental profits, potentially even more by the time you factor in the kind of loss of the high income child benefit charge, loss of personal allowance, the tax impact on not being able to fully deduct all of your mortgage interest, and so much more. So we see it now, about 98% of our clients that are investing in property are doing it through a limited company. If you've already got some kind of trading business already set up, there are a couple of different ways that you could actually set up your property investment SPV. So if you've got a trading business that cash flows well and you want to use the profits and the cash flow that you generate from your main business to invest over in property, that's where you're probably better off setting up a group structure. Tons of videos on this on the YouTube channel already. Essentially, we can kind of either do a share for share exchange, make it so you've got a holding company at the top, own your trading business, SPV over here, and you can move money tax efficiently between all of those companies without paying any extra tax. If you do it in your own name, then of course you've got to take the money out as dividends from your main trading business or loan it across, and in the long run this can create problems, and it's best to set up for success in the most tax efficient structure day one. If you're employed and you're watching this and you're just using your own income to invest in property, that's great. Set up a simple SPV and ensure that the money goes in as a director's loan. So when you set up the company, you might put 20, 30, £100,000, whatever you've got, whatever capital you've got available, into this new limited company to meet the deposit, stamp duty, legal fees, potential refurb costs and everything else. And it's just a case of setting up this company with as low a share capital as possible, putting that money in as a director's loan, because what this means is you can then take that money out tax-free. You can also charge interest on it. So it's a great position to be in, having your company owe you money, because if you're a higher rate taxpayer, you won't be paying over the odds in taxes to take it out. And over time, as you'll see in this video, the intention and the main aim when it comes to building wealth through property is to try and build up as much of a director's own account as possible, so that it gives you a really strong position to be in when it comes to actually extracting wealth from your limited company when you want to in 5, 10, 20 years time. So now you've got the right structure, how do you actually build wealth through property? And for a lot of people, this is building wealth through property. It takes time ultimately. Whether you're doing a hands-on investment strategy, flips or BRR, which you're very involved, you can accelerate the capital growth and as a result build wealth faster. Or if you're just doing standard buy-to-let off-plan investing where you're putting some money in, over time that will usually increase in value. You might put a little bit more in, release some equity, purchase the next one, and so on. Whether you're hands-off or hands-on investor, that's typically how you build wealth in property. Is ultimately it goes up, you refinance, buy another one, put more money in as a director's loan, try and build that director's loan up as much as you can. We're going to put some tips on how to do that as well later on in the video, but that's the main aim, is trying to increase the value of your properties, borrow against them at pretty decent rates, purchase the next one, and continue doing this for a long period of time. We've seen clients where they can build substantial wealth if they're active in property in a couple of years. If they're doing BRR, they've got decent funds available, whether that's their own funds or private investor funds. It could take a couple of years, but usually it's a slow slog, buying a property every year or two, adding whatever savings you've got in, have a bit of capital growth, refinance, and ultimately over the next 10 or 15 years, you will have wealth in property due to purchasing those assets and not taking any money out. If you start to take money out of your property company, you'll see that you'll use your director's loan account. You'll be paying over the odds and taxes if you're a higher rate taxpayer, and that will kind of hinder one of the benefits of the limited company is you will only potentially be paying about 25% corporation tax compared to 40 or 45 or 50% tax in your own name, which gives you a lot more post-tax capital to reinvest to the next deal. And because you're paying less tax, you've got more money to go in the next deal, which means ultimately you will get there a lot faster when it comes to acquiring, because the wealth will just snowball as you can purchase properties that bit sooner through paying less tax on those profits. And that's really the crux of it, is with property, it takes time, and make sure that you aren't taking the money out. You want that compounding effect. You want the money to reinvest at the lowest tax rate to go into the next deal and carry on and carry on and carry on. And the long-term game is to, if you want to retire in 5 or 10 years' time, have a large director's loan account, and here are some ways that you can potentially increase your director's loan account. So when it does come to wanting to take money out, you can take as much out as possible completely tax-free. Aside from the initial capital that you put in, so as I mentioned earlier, when you buy a property, if you put 25,000 in as a deposit for legal, stamp duty, that's a director's loan account, and you can charge interest on this, as we mentioned in a minute, and you can pull this out tax-free. But here are some other tips to maximise your director's loan account on a yearly basis as part of your accounts, to make sure that when you come to want to be taking money out, you've got the biggest possible loan account you can draw out tax-free. So the first one is, if you actually are a basic rate taxpayer but have a limited company set up, fantastic. Look to take a tax efficient salary out of your company. Up to 12,570 is pretty tax efficient. And the good thing about this is it's tax deductible in the company, potentially saving tax anywhere between 19 and 26.5%. And you as a basic rate taxpayer will only pay 20%. So there's a very, very low tax rate there, but it's better the money coming out being taxed at that 20% tax rate because you've saved the corporation tax, so it's a win there. And other ways, look to see if there's anyone helping in the business, whether that's your partner, child, relative that's actually helping. If you're doing a refurb, can you be paying them a small salary? If they're doing your social media marketing, can you be paying them a small salary? If they've got their basic rate tax band available, that's fantastic. If they've got their personal allowance available, even better, because that's completely tax-free. Other ways, so as I mentioned, your director's loan account, you can charge interest on this. So everybody, as a basic rate taxpayer, you've got £1,000 a year as a personal savings allowance. You can take this out as interest on your director's loan account, completely tax-free. Higher rate taxpayers is £500. You've also got the nil rate band as well, so if you do have low income, you can potentially take up to £5,000 out completely tax-free. Check out the video where I talk about this on the channel. I'll put that link in the comments. It also makes tax sense to charge as much as you can on your director's loan account where you've got your basic rate band available, because same principle with the salary. You'll be paying, if you've got profits in your limited company, you'll be paying tax at 19 to 26.5%. If we can lock in that tax rate on you personally at 20%, that's a no-brainer, because the money's out of the company and goes back in as a director's loan, building that wealth up, and it's locked in at that very low tax rate. Aside from this, make sure we're claiming the dividend allowance, although now it's a paltry £500. Used to be 5,000, but 500, use it or lose it, lock that in, because over the next 10 years, that's going to be £5,000 extra that you can take out tax-free as part of your director's loan account. And then we've got expenses. So as you'll know, business mileage, if you're using your personal vehicle for the benefit of your company, make sure you're claiming that 45p a mile up to the 10,000. If you go over and above that, it's 25p a mile, but that's £4,500 you might not be claiming, which the company can repay you cash, or you can just add that to your director's own account and take it out when you need it. Leave the money in the business so that it can buy more properties and so on. What else can we do? Well, looking at claiming all of your assets. So if you've got a mobile phone, well, actually, as a director of a limited company, you're allowed one tax-free mobile phone. Same with kind of computers, cameras, anything that you're using genuinely for your property business. Make sure you record it as an asset of the property business so the company can get a tax deduction on buying it. If you've already got the assets, sell them to your company at the current market value to increase that director's own account that bit more. Also, if you're working from home, make sure that you're claiming your home as office allowances, whether you're renting a room effectively to your company or just claiming the flat rate. Make sure you're using that because those expenses have been incurred anyway, and that can increase your director's loan account. You can get it per director, so over the years that will add up, and it's £312 a year for the flat rate. It could be more if you do work substantial hours from home and you can prove this. It's a great way to not be spending any more money but ultimately paying less in tax. And always, pensions are a good idea. If it's part of your long-term wealth building plan, you can make pension contributions tax efficiently via your company into a SIP, a SAS, your pension scheme, and this can be a great way to bring your taxes down if that stock market investing, the equities, the bonds is part of your investment plan, or probably not if you're just all in on property. And also, one we see clients often miss is training courses. They might have paid for this personally at the start of their property journey. Ultimately, that is a business expense, so make sure you're claiming that through the books. And any business travel you go to, often if you go to masterminds, you look at properties in different areas, make sure you're claiming all of the costs of traveling there. If you're going up north to look at the high yielding residential properties that you're looking at investing in, make sure you're claiming all of the mileage, the hotel, the subsistence whilst you're there, and any other expenses you incur, because ultimately the purpose of that trip was a business trip. So ultimately, as I mentioned earlier, the goal with property is to build wealth, build it all in that company, pay the lowest amount of tax, giving you the highest amount of post-tax capital to reinvest. Do this for a number of years, and ultimately you will build wealth in a company. And whilst you're doing that, try to build up that director's loan account so that all of the money isn't trapped in that limited company and you've got to pay shed loads in taxes to get it out. Ultimately, the aim is to have a high director's loan account when you want to start drawing it, so we can take interest tax efficiently, we can draw down the capital, because they're the main ways of getting it out whilst you're a UK resident. I hope you found this video useful. What's everybody's views on property investing in 2025? Let me know in the comments. I'd love to hear how you guys are looking at property investing in 2025 and beyond. Bye for now.